Okay, learning objective 2, page 100. The first section we're going to go through are the deferrals, right? The cash happened before the transaction. Okay, so prepaid expenses.
Paid in cash before they're used.
Yes, so the examples they give us are supplies, insurance, and depreciation, right? We buy supplies, and normally we would think, oh, it's an expense. No, we put it to an inventory until we use it. And then as we use it, we transfer it out of the inventory into the expense. Right? Okay, what type of accounts are prepaid expenses? They are assets, right? We have a claim to their value, right? They are worth something to us as the company. Okay, the next one they give us is insurance. Has anybody found an insurance company that lets you pay for insurance after the fact? No. No. You have to pay for insurance before, right? Then you use it up, and then it's an expense. Don't you like how that works? They get our money before, and we pay for something we never ever use, right? That's the goal. We never use it.
Is there a time when we would take that and put it in the expense column?
Yes, as we use it. It's a good example. Let's go through it. Okay, so say I'm going to pay January 1st. I'm going to pay for prepaid insurance, $1,200, credit cash, because they don't take anything other than cash, to record prepayment of insurance. And then I would say for 6 months ending June 30th. Okay? So on January 1st, when I wrote the check, this was what my journal entry looked like, right? So my T account for prepaid insurance looks like this, right? Now, as of January 31st, what happened? I used up 1/6, right? What is 1/6 of 1,200? Yes, 200. So what would my journal entry be?
The 2 pays.
Debit insurance expense, right? Because I used it up. 200, sorry. Credit, prepaid. To record January insurance expense.
So that's the total for like the whole year.
That's the total for 6 months, because that's what I said. Right? And then every month I would do this. 228, debit. And I'm going to start abbreviating here. Prepaid. And this is,
To record February.
yep. And then I'm going to have another credit. So I'm going to do this how many times?
Until the
6 times, right? And what's left in prepaid? I used all of it up, right? I prepaid for 6 months of insurance, recorded it to prepaid. Every month I moved, right, the appropriate amount from prepaid to expense because I used it. At the end of the 6 months, I have nothing left prepaid, and I have 6 months worth of expenses recorded. So what would my balance look like in insurance expense? Yep. Right? As of June 30th, I would have the full 1,200 there now. Okay, the next one that they go through on the bottom of 101 is depreciation. And depreciation is its own special creature, right? There's lots of funky things about depreciation. Couple things we can learn now before we really get into it later. What is depreciation? No, value doesn't go down. What is depreciation that we learn in our book? Because it's very different than what we think about in the real world. Yes. Has nothing to do with value. Remember what we talked about value? Value is a perception, right? Value, well, I don't think we talked about value. We talk about value in accounting too. The change in the value is something we learn later. Depreciation in its truest meaning is taking the cost of something that's going to last a long time and spreading it out over the time that we use it. So say I'm going to buy a piece of equipment. Do they give us an example? A printer? Yeah, they do. They give us a crappy one. Okay, let's do something big. How about a bulldozer? You read my mind. Okay, so I'm going to buy equipment. It's going to be a bulldozer because those are easy to think about. Okay, so what's my initial entry going to be for buying a $20,000 bulldozer? Debit equipment, and I probably financed it, right? To record purchase of bulldozer. Okay, how long is this bulldozer going to last me?
10 years.
10 years. Anything longer than a year, right? We're going to depreciate. Anything shorter than a year, it's going to be supplies. Okay, so equipment always has a life longer than one business cycle. Otherwise, why would we be dropping 20 grand on it, right? We would just hire somebody to do it for us. Okay, so we said it's going to have a useful life of 10 years. Can it last longer? Yeah, if we are super clean and crazy about maintenance, we can make that sucker last 20 years, right? But there are some rules, and the IRS helps us with those, about how long things are meant to last. We're going to say a useful life of 10 years. We're going to say at the end of those 10 years, its salvage value, which means what we would get left for the parts, we're going to say is $1,000. For tax purposes, the IRS tells us that the salvage value is always 0. But tax accounting and financial accounting are very different. Okay, so financial accounting, we almost always have a value. Because we know at the end of the 10 years, we could sell it and make some money, right? Whereas tax is like, we don't care about what you're going to make. It's a separate issue. But for financial, we know we're going to get something, right? Even just for scrap parts, it's going to be worth something to somebody. Okay, so how do we calculate depreciation? for all of you math equation people, cost minus salvage value divided by useful life equals depreciation per year. So what is it for this one? 20,000 minus 1,000
over 10 years.
over 10 years.
That's 19. That's
Yeah, $1,900.
Yeah, it counts on the zeros.
$1,900 depreciation per year. Okay? So how am I going to record this? Depreciation is an expense. So what would we do? Debit depreciation expense, 1,900. Where's my credit go? No. We have a special rule in accounting that when we buy equipment or anything that we put on our balance sheet as an asset, we don't hit the depreciation directly to that account. It goes to a contra asset account, which is accumulated depreciation. It's an asset account, but it behaves the exact opposite. So it carries a credit balance for the sole purpose of tracking the depreciation separate from the equipment. Remember we talked about historic value? It's important to maintain what we purchased something for, the cost. It's going to be accumulated depreciation equipment. To record depreciation expense on bulldozer. Okay, so our equipment has 20,000 for the bulldozer. Depreciation expense now has 1,900. And accumulated depreciation has 1,900. Okay, so after our 10th year, what's the balance going to be in accumulated depreciation? 19,000. Right? 10 years worth of $1,900 depreciation per year is going to give us a total accumulated depreciation of 19,000. Right? We're going to do this 19 times. 10 times. Right? So on and so on until we have a total of 19,000. On our balance sheet, when we list out our equipment, we offset it with accumulated depreciation. At the end, we will have accumulated 19,000, right? So our net value, or net book value, is going to be $1,000. What does that equal? Our salvage value. Yeah.
Why would we need to record the depreciation?
Why? Why do we need to record depreciation? What was the point? At the very beginning when we talked about what depreciation was, what did we say about it? What's the whole point of using depreciation? We bought something that's going to last us longer than a year, right? So we need to spread out this 20,000 over all of the years we're going to use it. Well, we're going to use it for 10 years. So we need to take out 10 pieces of that equipment and spread it out over every year that we use it. at the end of the 10th year, it's actually going to have a little bit of value left, so we don't depreciate that part. Okay, so depreciation is just allocating the cost of something over its life. If it's going to last longer than a year, we have to spread it out over the whole life.
Wouldn't that be with the notes payable then?
The notes is just the money paying for it.
Right.
That's separate.
But you still add the thing. It's not like you're paying for it every time.
Correct, but that's the cash payment side. So what if I had paid cash for it? Then what?
Still have the same number. I'm still not understanding why you need to report depreciation.
Depreciation, equipment is going to last us longer than 1 year. So we're spreading out the value of that equipment over the life it's going to last.
Is it like a tax thing that you have to pay taxes on depreciated value?
No.
No, it's not how much you're paying every year for it, pretty much.
You know what your assets are. So it's like, my car used to be worth $30,000. Now it's worth $5.
No, that's value. That's separate.
So then-
That's value.
So then why are we reporting? If that's the value and not the.
Because value doesn't belong on our financial
So
statements.
depreciation would be a value.
No, depreciation is only allocating the cost over the time that we're using it. Has nothing to do with value. We think of value because we think of our car, right? And how much it's worth compared to how much we paid for it. But that's separate.
Would it then, one of the, like, historic purchase principle or whatever it is called, wouldn't that then, that would go against it, wouldn't it? Because you would just want to report the 20,000 at the time you purchased it and not over time.
Start from the beginning. I think you're combining the asset and the financing. The financing is separate. Paying for it
Right.
and the interest you pay for it, that's a whole separate entry.
So you pay for it with the notes payable.
Mm-hmm.
It goes on the note, and you have the equipment.
Mm-hmm.
Why are you reporting depreciation?
Because this equipment is going to be used. We are going to generate,
Right, you use
hold
it
on.
for more than 1 year.
Right, so we're generating revenue with it. So the expense of this equipment doesn't only belong in year 1. The expense of this equipment needs to be spread out over all 10 years that we use it to generate income. Right? If we were to take it all in the first year, if we had revenue of 100,000 and we took all 20,000 in the first, we would have net income of 80. But we didn't use up the whole value of the bulldozer in year 1. Right? The bulldozer is going to continue to be an expense over the 10 years that we use it. So we would really only take the 1,900 as expense in year 1, giving us 98,100, right? That's an $18,000 difference in net income. It's a way of spreading expenses over the life of the asset that helped generate the revenue.
But don't you have like expenses on like fuel and other stuff?
That's separate. We'd still record all that.
Right.
That would be
But-
in addition to depreciation.
So I guess I'm just not understanding why we report depreciation. It just seems pointless.
Okay. I can understand that. We'll get there. You'll get there.
Will this help you when you decide to sell the equipment in the future? I mean,
Mhm.
it's going to help you figure out what the value.
It can, yes. But one thing that we will learn is that book value of assets compared to what it's worth on the market are very different. So say at the end of this 10 years, they don't make this bulldozer anymore, so you can't get parts to fix it. It may not even really be worth the $1,000 that we have it on our books for, right? It may be worth 500 because somebody's just going to pull one part off of it and the rest is garbage. Or if you kept it like pristine and you painted it and you waxed it and you greased it and you did whatever you need to do to keep it up, it may be worth $5,000, right? It may have a higher value at the end, but it still was an expense every year generating revenue for you. We will work on depreciation. This is just like a little snippet of it.
Is there a benefit to doing it this way than just putting it all in 1 year?
You can't put it all in 1 year. That's not GAAP. GAAP is matching the expense with the revenue. If it's gonna last more than 1 year, you have to spread out the expense over the number of years you're gonna use it. So we're gonna use this for 10 years. We have to spread out the expense of buying it at 20,000 over all 10 years. That's GAAP.
If in the example that kept it missing was more at the end,
Mhm.
Would there be like an extra column of the T accounts where the accumulated depreciation still got to the 1,000 at the end, but since we put money into it, it was somewhere else and that increased?
The maintenance cost would just be a straight expense in the year that we did that. So if we were keeping it up every year and we were spending $500 on maintenance, that would be a $500 expense in the year we spent it for maintenance. But it wouldn't increase our equipment.
So which month of the fiscal year would you record the depreciation in?
Usually the last one, but depending on your system, you may record it monthly. You may break this 1900 into 12ths and record it every month. Depends on how you issue financial statements. If you issue a monthly financial statement, you're going to record it monthly. If you issue quarterly, you're going to divide this into quarters. But at least by the last day of the year. Okay, so deferrals. Something happened, right, before we used it. So prepaid expenses, we got the supplies, we paid for the insurance before we actually used the expense. Depreciation, assets have longer lives, right? So we have to break up the expense over the life of it. Page 102 talks about the contra asset. That's where we put accumulated depreciation. It's an asset that acts the exact opposite of an asset. So its normal balance is a credit, right? Because it's offsetting the balance. It's important for us to see the balance as the net of the two. But on our balance sheet, we want to see the original purchase price because that's important in financial reporting. That's on the bottom of page 102. Contra account is preferable because it discloses both the original cost of the equipment and the total cost that has been expensed to date. That is accumulated depreciation.
So that's what
Uh-huh.
like the accumulated depreciation is the contra asset account?
Yep. You will have an accumulated depreciation account for every type of asset.
There's more types of contra asset accounts, or is it just depreciation?
Depreciation is the only contra asset. We will learn about other contra accounts later on. Yeah. Okay, on page 103, the book value is the difference between the cost and its accumulated depreciation, right? So at the end of the 10 years, we said our book value was the $1,000 because we took the original cost of 20, subtracted off all the depreciation, and what's left is our net book value. That's what is left, what its value is left on our books. Bottom of page 103, prepaid expenses. Gives you some examples with the description. Okay, the other one, unearned revenue. They gave us the money before we actually provided the service. Kind of like a deposit, right? They still have claim to the money, but we have the money, right? So we either have to provide the service or give the money back. I think this one's probably the easiest of them, right? We receive the money, so it's cash, increase to cash, and then it's an increase to liability because that's what unearned revenue is. That's pretty straightforward. We don't tend to earn revenue bits at a time, right? We usually do the work and earn all the money. There are occasions where we'll do some of the work and we'll bill it, but for the most part, we're going to bill the whole thing. So if somebody pays me for advertising and I'm gonna work up an ad, I'm gonna prepare the ad, provide the service, and then say, okay, I've earned all the revenue, and then I'm gonna reclassify it from unearned to earned. Sometimes lawyers will do the bits, right? If you put in a deposit or a retainer, say you give them $1,000 retainer, they bill by the hour, so they're gonna say, okay, I worked 1 hour on your case, I've used up $250 of your retainer, that is now earned income to me. And they will reclassify an hour's worth of your retainer. But for the most part, we earn the whole thing. So that example is on page 105. Okay, I think we're gonna do it number 2, top of page 106. Cover the answer, talk about it in your groups.